Let's imagine for a moment that the key to building your fortune lies in smart investing. You've got $1,000 burning a hole in your pocket, and you're ready to watch it grow. But here's the twist. Is this a one-time deal, or will you keep adding to the pot? Either way, you've come to the right place to discover the best moves for your money. You've hustled and saved $1,000, eyeing the stock market and perhaps some riskier ventures. First off, hats off to you. Saving that first $1,000 is a milestone many never reach. However, here's the reality check. If this is your only grand for a good while, diving headfirst into the stock market might not be your golden ticket. Let's play out a scenario. Say the market sees a stellar year, skyrocketing with a 25% return, a figure that even seasoned investors would give a standing ovation to. Sounds thrilling, right? But here's the catch. If you're playing in the big leagues with, let's say, $100,000, that 25% means a whopping $25,000 gain. But for your hard-earned $1,000, you're looking at a modest $250 return. It's a nice dinner out, but not exactly life-changing. Weigh your moves and think about the time invested versus the potential payoff. Thinking about tucking your cash into savings or a CD for those guaranteed returns? Let's break it down. Savings accounts, while cozy and safe, aren't the money magnets we'd like them to be. The average return on these accounts is, well, lackluster. After 5 years, your ambitious $1,000 might grow by a mere $100. Sure, it's safe, but turning millionaire at that rate? Probably not in this lifetime. Now, on to CDs or certificates of deposit. Think of them as savings accounts on a timer. You commit your money for a set period, and in exchange, they offer slightly better rates. But, and it's a big but, touch that money prematurely and you'll face penalties. With a 5-year term offering an average rate of 4%, your $1,000 might mature to a humble $1,200. That's a decent gain, perhaps enough for some trendy apparel, but waiting a half a decade for a shopping spree? Not the dream scenario. You might be tempted to venture into the stock market, which, with an average return of 7% over 5 years, can bump your $1,000 to $1,400. It's a better deal, sure, but still not the transformative change we're chasing. The takeaway? While all options offer growth, none promise the kind of wealth that changes the game overnight. Making money takes time, strategy, and often more than just $1,000 to start with. Feeling a bit uneasy about where to put your money? Don't fret. The real gold mine, it's within you, and the way to tap into it is by growing your wealth through self-investment. A vast majority sail through life without scratching the surface of their true potential. As the legendary Warren Buffett aptly put it, the greatest investment you can make is in yourself. This isn't just about money, it's about upskilling, learning, and becoming indispensable. Simply put, the more valuable you are, the heftier your paycheck. How can you elevate your worth? Dive into books, webinars, seminars, or courses. Equip yourself with in-demand skills that companies are willing to pay a premium for. As we see upheavals in job markets worldwide, those armed with skills like marketing and coding are riding the wave, as they are precious commodities in virtually any industry. The trick? Seek out skills that are in high demand but in low supply. Taking inspiration from Charlie Munger, develop into a lifelong self-learner through voracious reading, cultivate curiosity, and strive to become a little wiser every day. It's a domino effect. The more you learn, the more you grow. And as you flourish, so will your wealth and happiness. Invest in yourself and watch the dividends roll in, both in wealth and well-being. If you're finding this video valuable and want more ideas to unlock your financial potential, hit that subscribe button below. Ever thought about what else you can do with $1,000? How about planting the seed for another stream of income? We're in the golden age of the digital era, making it simpler than ever to cultivate additional income through the internet. Granted, laying the foundation and propelling that venture takes grit and determination. But here's the game plan. Start by investing in knowledge. Absorb, learn, and then act. Use the profits from your venture to nurture its growth. Once it's thriving, consider diverting funds into the stock market. If you've got that initial $1,000 and you're committed to feeding it monthly, the financial playground is yours for the taking. Remember, a continual inflow of cash doesn't mean you halt your learning spree. Investing in personal growth is a long-term strategy with impeccable returns. Now, here's a nugget of wisdom to chew on. Passive income. The goal is to make your money hustle for you while you also chase your dreams. Echoing the sage words of Warren Buffett, if you don't find a way to make money while you sleep, you will work until you die. And honestly, who's signing up for a lifetime of a non-stop grind? Many visualize the stock market as a place to dip their toes into vast company pools. It's not just about buying a slice of Tesla or Google and hoping for the best. Owning stock means you've got a stake in the game. When they profit, so do you. But if they stumble, your wallet feels the pinch. In essence, the stock market offers a potential route to passive income, but it's not the sole path. The main aim? Find ways to let your money work tirelessly for you, all day, every day. After all, financial freedom is the dream, right? Investing in individual companies can indeed be a roller coaster. You might strike gold with massive returns, or you could plummet into losses if you pick wrongly. The golden rule? If you don't have the time or inclination to deep dive into company research, steer clear. Investing isn't just about spotting the next Apple or Amazon. Enter index funds, your financial shortcut. Think of them as a buffet of companies. Rather than trying to guess which dish or company might taste the best, you get a bit of everything. So whether you're keen on diving into the broader market, specific sectors like tech, or firms that offer dividends, there's an index fund tailored for you. The beauty of index funds? They're accessible, as simple to buy as individual stocks. But remember, investing isn't a guaranteed win. Even with index funds, it's crucial to do your homework and not just jump on the bandwagon. For newcomers eyeing a safe bet, general market funds are a good starting point. For instance, SPY gives you a slice of the top 500 U.S. companies. The general rule of thumb: when the U.S. economy thrives, so does your fund, and vice versa. Tech enthusiasts might find QQQ appealing. With this fund, you're investing alongside tech giants like Microsoft, AMD, and Alphabet, Google's parent company. Just remember, each fund has a unique mix of companies, so it's wise to peek under the hood and see which one resonates with your preferences. For those on the hunt for consistent cash flow, dividend-focused funds like VYM or SDY are worth considering. Investing here means aligning with companies that reward you just for being an investor. In conclusion, when diving into the investment pool, seek the strategy that gives you the most value for your money. Your financial journey is uniquely yours, so carve a path that aligns with your goals and risk tolerance. The golden rule of investing: pay yourself first. Whenever the paycheck hits, set aside a good chunk. Take 10 to 15%. Deposit it straight into your investment account. This approach ensures you don't inadvertently spend funds meant for investing. As the oracle of investing, Warren Buffett wisely advised, do not save what is left after spending, but spend what is left after saving. Now, let's talk real estate. While a grand might not snag you a mansion, it can certainly pave a pathway into the property market. Thanks to the digital age, platforms now allow collective real estate crowdfunding. You can contribute smaller amounts, like your $1,000, pooling with other investors. As the property value appreciates or yields rental income, you reap the benefits. But remember, real estate is a long game. Your investment is anchored to tangible properties, making it a tad trickier to liquidate compared to stocks. If direct real estate isn't your jam, consider REITs, real estate investment trusts. It's like stock market meets real estate. By investing in a REIT, you're buying into companies that own or finance properties. You'll earn dividends from rental income or property sales, all without the strings of physical ownership. A bonus? REITs often dish out heftier dividends since they're obligated to distribute 90% of their income to shareholders. Fancy dipping your toes? Check out options like O or VNQ. Lastly, if the investment world seems too daunting, there's always a fail-safe route. Use your money to squash debt. Prioritize eliminating any outstanding dues ASAP. After all, financial freedom often begins by breaking the chains of debt. Making strides in your financial life isn't just about investing. It's also about dodging the pitfalls of crippling interest rates. Think about it. Constantly borrowing money at exorbitant rates like 8% or 20% sets you back, placing you on the losing side of the financial equation. Think of debt as the anti-investment. Paying off a loan early is akin to earning a return on that loan's interest rate. For instance, if you have a loan with a 4% interest rate, be it for a car, a mortgage, or student loan, settling that debt a year in advance essentially earns you a 4% return. How? Well, that's 1 year less of handing over your hard-earned cash to a financial institution. So if the volatility of the stock market unnerves you or diving into real estate feels premature, channel your funds towards clearing debt. Doing so not only relieves future financial burdens, but also boosts your monthly cash flow. Every debt you clear means fewer interest payments, leaving more money snug in your wallet.